Hello and welcome everyone to another weekly market commentary from StashAway. Of course, with us again, still from home, Freddy Lim, our Chief Investment Officer. Hey, Freddy.
Hi guys, how are you doing?
I'm doing well. How about yourself?
Well, getting ever closer to the second phase of the unfreeze of activities, so I'm excited.
Yes, same here. Same here. Finally able to visit people's houses again, right? And seeing other people than just your household. So for baby steps, but at least steps in the right direction. So I'm sure everyone listening to this is looking forward to this here in Singapore. Did have a couple of things to discuss, right? I think from last week, since we spoke, last week was a down week for the markets, Freddie. This week, however, we've seen this a reversal happening, right? There was some, Fed speak going on Monday or Tuesday. Maybe can you give a little bit of an insight there on what happened compared to last week, and why did they go from like being very negative again last week because of second wave concerns to now having the market, being up again?
Well, I think the market needs to realize the Fed message last week was not intended for the markets. It's intended for policymakers on Capitol Hill. The Fed is trying to remind the politicians that they still need to do their part. A lot of heavy lifting has been done by the Fed. The market has done well because of that. But the real economy will be better served with more targeted and more specific aid programs. And the bickering on Capitol Hill hasn't got anywhere close yet. So that was why they sounded gloomy on the real economy. But the market didn't like the message that the Fed governor is gloomy. But soon people realized that the Fed has actually pledged to maintain indefinitely, as long as it's necessary, those programs that they have in place. They are buying $80+ billion of assets every single month indefinitely, and that was a pledge that people missed, right? So it's sort of a bit of a signaling to Capitol Hill, but not well taken by the markets. Markets sort of realize it now that of what I just said, right? That set the stage for beginning of this week, and however, there was some good news on the Fed actually coming in to buy corporate bonds and ETFs on corporate bonds. At the same time, Huawei was the U.S. has allowed Huawei to collaborate with U.S. companies on 5G networks. There was a surprise, and I think lastly, there was another talk of the Trump administration planning another $1 trillion infrastructure package, right? So the collective of these three good news on Monday really lifted the markets. Until yesterday night, we had a resurgence in Beijing's virus infection that sort of tempered that momentum.
Yeah, and I want to discuss this for a second. I think we're seeing a lot of resurgence also in certain U.S. states, right? People are also getting quite, Donald Trump is going back on the road now for his campaigning, and he's making people sign off on the waiver forms at every stadium that they're not responsible for any, COVID-related illnesses. But you see that these different pockets, having resurgences. We saw it in South Korea a few weeks back. We're seeing it now in Beijing. Do you see, with more countries, EU opening up now completely, pretty much between the member states again, right? Asia coming, back online. I think, Indonesia is opening up again for retail and things like that. Do you see this as a big threat to markets, or is the market already kind of like pricing this in even?
I think with where the market is now, which is a lot higher than the bottom on 23rd March, it also meant that the amount of recession that's priced into the market is more shallow than before. And that raises, in the probabilistic sense, for more volatility. So I think one thing's for sure, that you need to stay vigilant. You need to continue to have a diversified portfolio, right? The right risk level in your investment plans. You need to stay true with that regardless of what the market is, whether it's up or down in the near term. You need to just stay on that, because I think volatility remains elevated. If you look at the VIX futures markets, for example, the options market is telling you that over the next 9 months, where the futures are trading, the options market is not expecting a return to pre-COVID-19 volatility level. So we will get more volatility, and I think all investors should continue to adjust for that new volatility environment, right?
Yeah, no, I do agree there. One last thing before we get into the Q&A, because we got some really good questions again from listeners over the week, is yesterday's China-India border tensions escalating a little bit further. There were some death among soldiers, right, on the borderline there. Do you see this? Is this just a geopolitical haggling there, which we've seen before in other countries as well, and markets not really paying too much attention to it? Or do you see this being able to grow into a more, full-fledged possible downside scenario for markets?
Historically, the border tension has always been there, and it's bigger than between US and India. And in fact, in the South China Sea, there's plenty of that kind of dispute, all the way going from Japan, Taiwan, and all the way down to as far as Malaysia, if you want to focus on that. So the territorial dispute will always be there, and opening up chances for meddling by, say, the US into the regional affairs. However, the reality is US has pulled troops away from the region, right, since Donald Trump's taken power. The fact that Trump, although it seems unpredictable, but if you look at his actions, they're not. They are the words are fire and furious, but the actions are not. Look at Huawei is now suddenly allowed to collaborate U.S. firms on 5G networks. So there's a lot of inconsistencies in how tough the U.S. want to get. I'm not sure there's a resolve on that. So there will be a lot of this that research, but they wouldn't really do anything to focus the market's attention unless it really evolved into a full-blown the dispute that involve warfares. We are very, very far from that, and these things has historically been there. It's just a rotation of the news flow at the moment.
Yeah, and I don't really think that either of those two countries are in the mood to have a full-out war right now. So let's move on to the Q&A, Freddy. Like I said, we got quite a few of them. Let's see how many we can touch on today. For anyone else who wants to have their questions featured, please feel free to always put them down below in the comments box so that Freddy and myself can pick them up. With a question from Gautam. He says, I noticed you mentioned you re-optimized away from the US a bit, given the prospects of a weaker USD in the future. In light of that, are there any other markets you're focusing on as a result? Personally, he has been pretty bullish on Vietnam, giving supply chains, when rebuilt post-COVID, could entangle themselves there and a hedge against all this over-reliance on China for supply chains. Would love your thoughts on this as well, Freddy.
Thank you. Very interesting, and we are constantly looking for differentiated profile that we can find from asset classes that we can include into the portfolios. Unfortunately, in terms of ETF development today, Vietnam is not as liquid and cheap to invest via ETFs. But more importantly, although I buy the story of the supply chain, development in Vietnam, that flow has actually slowed, given the trade war has actually got escalated. But COVID could actually continue to see people rebuild that. So, however, there's always the devaluation of the dong. That's always hanging. That's always been there for investors, and unless it's the currency has already been devalued and more freely floating to reflect that, the confidence of investors going full on into Vietnam is always going to be a measured one. But it is interesting is we are monitoring such opportunities over time. And whenever the ETF space allow us to track it more cheaply than today, we do have those interests to include interesting countries like Vietnam, Cambodia, Myanmar that has different stories. So we are on the lookout for this. Sorry, having said that, we do have. It's this sort of remind me to check if to see whether AAXJ, which is on our platform, what percentage of those countries we have directly or indirectly through some of the ETFs that we already have. So this is actually a very good question to remind me to look for something else. So thank you very much for the question, Gautam.
Yeah, thanks, Gautam. Really good question indeed. Next question, let's go through this. Ritz is asking, Freddy, what is the forward-looking data telling you about where our global economy is heading, considering most of Q1 20 data is out now? Q2 is definitely going to be worse since most of the global lockdown was during this time.
We mentioned before, between the mid-Feb to mid-April, data, even leading indices, weren't available. And the moment they were available on 17 April, the data just gapped down. At the moment, the May data further deteriorate, but I think that's priced in by the market. So as you knew, the StashAway during this period, knowing full well the difficulties during the lockdown, right, in terms of data collection, quality of data, and also the timeline in terms of when the data would actually fully reflect the COVID-19 impact, right? All these things are sort of created a lot of problems for economists. You've seen that a couple of weeks ago, the U.S. non-farm payroll unemployment numbers were way off, right? Most economists' estimates were way off. Consensus were for a negative 20% unemployment rate. It came in at 13 as a positive surprise. So it goes to show that how difficult it is to collect good, precise, accurate picture in terms of the economics. So that will still linger on for a while until we are fully unfreeze. So at the moment, where we are is to infer growth expectations from market prices, and it is pricing only a shallow recession. It does look like the data right now is reflecting the left side of the V-shaped expectations of the markets. Only time will tell, given that we still need a few more months of data to come in before we can see the rate of change more accurately from the economic side. And at the moment, there's not very good quality picture out there for economists just yet.
Yeah, and I think also yesterday, I think they released the retail sales that were through the roof, right? In terms of growing again in the US as an example, and the builder sentiment was up again as well. So I think you're seeing already, but still they're very patchy, right? So this could be next month already. It could be completely opposite again right now, because I think, like I said, they might lag in terms of timeline as well, right?
That's right.
Yeah, thanks, Ritz, for that question. Let's move on to. I don't know the name because it's not a real name, but we'll go with the question anyways. And it's something that we kind of really quickly covered already last week, I think, as well. And it is about, would StashAway consider adding silver or other metals like cobalt or lithium used in batteries to the portfolio?
I would love to. Those are extremely interesting metals that reflect, like cobalt and lithium, they have very specific uses in industrial purposes and even the making of plants and equipments. And they are extremely interesting and a good diversifier. Silver can add to gold as a portfolio insurance. However, the problem with the tracking error with ETF is that the tracking performance is poor today. And it's sort of related to the so-called contango effect of a lot of the commodities. The simplest way to think about it is that for the fund to invest in those commodities, they tend to invest on rather than investing in directly buying physical metal and storing in a warehouse, they do so through the futures markets. But the futures market have a certain structure, and in a way, they reflect cost of storage, reflects expectations as well. And the contango, which is basically in the contango situation, if these funds they have to track by buying those metals, and if there's a very steep contango, what it means is that if they continue to hold those positions over time, they will suffer a decay in the value of those futures contract they hold, leading to a natural loss as time progresses. And so the contango problem was especially acute for energy, for oil, West Texas oil contracts. We knew that it went to negative $37 at one point, and that has a lot to do with storage capacity, supply disruptions, and the contango is really the reflection of all that. So it is complex for ETFs and even a lot of the funds to do a good job tracking when there's a lot of acute problems in contango. So what I'm trying to say is that today I do not expect the ETF fund managers to be able to track a lot of these commodities well. But I would love to add them at some point. We are constantly monitoring their performance in terms of whether when the market is up and when the market is down, whether the tracking error is better or worse. The moment we have more confidence in their performance in tracking those assets, we would like to include them. Again, great suggestions. I would like to thank NX No Winners for it.
That's why I wasn't sure about the name. But yeah, no, I think good question. I think also good for people to understand how we think about adding new products or new investment vehicles to our platform in the future. So thank you, Freddy, for giving us a great insight there. I think we're running a little bit out of time. I know we have a couple more questions that we wanted to get to. Don't worry, we will get to your questions next week. But I just want to get really quickly in our next upcoming webinars. So we have 2 of them again coming up next week in Singapore. We have a webinar actually done by Freddy. It's a deep dive into StashAway's advanced investment framework. So that's something that Freddy does himself. That's on Thursday, the 25th of June at 7 p.m. So please feel free to sign up for this. You can also ask Freddy directly any of your questions during the webinar that he can answer. In Malaysia next week, on Wednesday, the 24th of June, we'll be talking about investment basics. You can sign up for that again as well. There are going to be links in the comment section or show notes section below the video, as well as you can find them on our websites, as well as Eventbrite, Facebook, or wherever else you are following us. With that being said, again, thank you, Freddy. Good to see you again today. Thank you for everyone's question. Let's keep them coming so we can make this very engaging for all of you. And we'll be with you next week. Bye-bye.
Ciao.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.